My name is Annabel Murphy. I work for Fusion Labs, which is a corporate innovation consultancy. And I'm hosting this panel today with Stephen Dash, who is the CEO and founder of Credible, a US-based online student loans marketplace, and Dean Dorrell, who is the co-founder and principal of Carthona Capital, an early-stage Australian VC company who backs Stephen in the very early stages of Credible. So we're going to be having a bit of a discussion today about their journey together, how and I suppose when they identified this opportunity in the US student loans market, and then just a bit about where to next, as well as some advice for other fintech people in the audience, particularly around going into new markets and, of course, raising a lot of capital. And then we'll have a few questions from the audience. So just to kick off, Stephen, do you want to give me a bit of background on yourself and on your business, Credible?
Sure. So thank you, Annabel. The business started in 2012. It's a US consumer finance marketplace. So we got started in the student loan category. The way to think about Credible is we're like Expedia for consumer finance. So we give borrowers the ability to see options from multiple lenders, and then we help them through the process of origination. So as distinct from a traditional lead gen site where a site will often sell a lead to a lender or a number of lenders, we're helping the borrower through basically 90% of the origination process. So the company started in 2012, we're about 5.5 years old, and we listed on the ASX last year in December.
Excellent. And Dean, yourself, one of the very early seed investors into Credible. Give us a bit of background. You've had an exotic investment banking background in London, and now you've moved out to Australia. Just give us a bit of background on yourself and perhaps on your fund as well.
Thanks, Annabel. Yeah, so I'm originally from the UK. Investment banking, really one of the early stage of quants. So I was a coder and someone that really knew how to program and mix finance. I didn't do that for a huge amount of time. Investment banking isn't the most healthy of places to have a career in my view. I did an entrepreneurial sort of career of starting companies and then having a private equity and distress turnaround life before I arrived in Australia 8 years ago. I met Stephen when we both worked at the same fund, MH Carnegie & Co, where really I could see what Stephen was like as a person, and that's the best due diligence that you can ever have, is working alongside someone and really trying to solve problems and make decisions. We both left that fund at pretty much the same time. Stephen to head off to San Fran, and me to set up my own VC fund, which is called Carthona Capital. Really concentrates on really early stage businesses, seed and Series A. Heavily involved with companies, daily, weekly contact. So high conviction and highly motivated to really push companies to the next stage.
And so, Stephen, you decided to go to San Francisco to start Credible. Tell us about the opportunity that you saw.
Yeah, so back in 2012, the term fintech really it wasn't a mainstream sort of term that people were thinking about. I think it was prior to a lot of the consumer finance platforms in the US really gaining a lot of traction, like Lending Club and Prosper. They were around. I think Society One was around here in Australia, but fintech hadn't really taken hold. So there wasn't really a fintech ecosystem at that time in San Francisco. But basically, what I saw was consumers who were effectively my peers, about my age, in the US, were paying off hundreds of thousands of dollars of student debt, and there was no risk-based pricing on the debt that they were paying off. So that was the bit that didn't really sound right to me when I first sort of heard about it. So I did a little more digging on it and realized that there was mass consumer confusion. There were people getting ripped off paying 7 and 8% interest rates on their loans when Libor was at 30 basis points. So that was really the catalyst, where there was almost like an arbitrage there. And so fast forwarding, a whole bunch of banks saw that as well and got into the space. We started a marketplace when there were really two lenders offering the product. based on conviction that there would be more lenders get into the market because this was such an attractive asset class for a bank. Being able to acquire a millennial high credit customer early in their life cycle is super valuable for a lending institution. So that was really the early days.
And Dean, then how did you then get on board? You obviously saw that opportunity as well.
Yeah, it's interesting because often the US is seen, especially from a technology point of view, to be really leading the way. And I think Stephen and I both brought a European and an Australian aspect to intermediation and marketplaces. Really in the US, where you've got so many thousands of banks and a really, really fragmented financial system, that there's not really been a push to have the comparison sites and marketplaces that we've seen emerge in Europe and here. So I think that was the first thing that really together that was the thing. Well, Stephen was obviously the leader of that, being the founder, but I was the first investor there, so he had to sell me on that bit of our common knowledge. What could we do in the US together?
And that was sort of just to add to that, that was sort of the start of it, and it's since really progressed from there, where the platform that we've built goes so far beyond just traditional lead generation or comparison, where we're taking a borrower through that process. And we heard earlier from some of the point of sale companies that are here talking about convenience and ease of use, particularly for millennial consumers who have grown up in the world of Amazon and Kayak and Expedia. They're just used to simplicity and getting things happening super quickly. So really our platform has evolved to, there's really two elements to it. One is providing people with accurate rates of credit in real time before they commit to the whole process, and we've had to integrate with a whole bunch of lenders to do that. But the second piece, and what I think is really important and will continue to be important, is making that whole process really, really quick and easy for someone. So taking all the friction and pain out of uploading documents, providing a proof of income or proof of graduation in the case of a student loan. You can use third-party services to do that or build your own proprietary services to deliver on that for the customer. So it's really extended beyond just this light bulb moment of people are getting ripped off, they need to understand their options, comparison's a good starting point, and over the course of 5 years we've really built a core technology platform that allows us to do a lot more than that.
And how does the US compare in terms of online lending markets? How does it compare to, say, Australia and Europe?
I would say the key difference is, like Dean said, people haven't grown up with the Aussie home loans of the world over here. They're not really used to that comparison. That's because of the fact that there's such a, there's basically 50 different countries inside of the US because there's state-based lending legislation in each state, etc. So people aren't used to that. They're used to it in retail and travel. And so that was the key difference that I saw and continue to see. And there's also a lot more fragmentation over there with a ton of banks and this sort of new wave of alternate lenders. So there's 5 or 6 really big banks, but they don't have the dominance that the banks have here or in Canada or in the UK. So there's a longer tail of providers and a lot more specialist providers. So I think a marketplace is even more suited to the US. It's just a question of how do you dominate such a big market compared to some of the smaller ones where I think it's a little less challenging.
Dean, did you want to provide any comment?
No, I would say that it's the confluence of events really where a finance business born from ground up, which has got millennials as their real focus, and in the next 10 years, millennials are going to be completely dominant in terms of our customers, but also using technology as a differentiator that you can, if you build from ground up, and so many of legacy players across the whole finance spectrum have got huge technology issues with legacy technology. So if you can build from ground up and use that as the way to attract and convert customers, it makes a huge, huge difference.
And so what can the Australian banks learn and other credit institutions learn from what you've done in the US?
I think it's maybe less what we've done, but what the ecosystem has done in the US. So I sort of think about the fintech players as either collaborative or competitive for banks or for incumbent institutions. So we would sit firmly in the bucket of collaborative because we're helping enable some of the traditional lenders who have the benefit of low costs of capital, who have the benefit of an installed user base, to leverage our platform to acquire new customers and acquire customers in different geographies or different credit buckets, etc. Or competitive, where you've got, you know, the guys who are taking on, and it's becoming the competitive fintech players are becoming increasingly collaborative as well, because they're partnering with banks from a capital provision perspective. So I think the learnings are that whether you're a big bank or you're a startup, it's really important to collaborate in the ecosystem, because there's different attributes of value that each party brings to the table, whether it's speed and, you know, agile development, where, you know, you might release a new version of your platform once a week. If you're a startup, you might release a new version of your, you know, your platform or banking app or whatever once a quarter if you're a traditional institution. And for some of our lenders, it's even less frequent than that. So I think it's embracing the ecosystem and extracting the comparative advantages from each bucket of participant.
Do you think the US tend to do that a little bit better in terms of collaborating startups and banks?
It's a little different there, because the dominance of the banks here means that there's probably a little, you know, there's a little less bargaining power, I guess, for startups or for earlier stage companies. I think in the US, what's happening now is we're seeing buy-in from the executive level of a lot of the big banks. So, you know, we were at a dinner last week with, you know, basically the COO, the guy who runs the bank of a top 10 bank in the US, who wanted to know all about what, you know, five fintech companies were doing. And he was legitimately invested in understanding what the ecosystem was doing. Now, that's a change from the last couple of years. So I think the traditional banks in the US, and as I say, there's a long tail of them, but even the sort of super regionals, as they're called, they are definitely engaging in a big way and throwing real senior resources at understanding how they can extract the best value from some of the earlier stage players or the technology players.
And Dean, do you think that, how do you think Australia banks and are collaborating with fintechs? Do you think it's you know, happening more in Australia and compared to, say, UK, where you're from?
We're certainly starting to see that. Obviously, you've got two of the big banks with CVCs, with corporate venture funds, who are often doing things quite early. I still have my suspicions that really they've got massive profit pools to protect, and they'd rather there was no competition. Yeah. So, you know, I'm still wary of those guys looking over the shoulder. Maybe some people here, but, you know, I'm wary of them looking over the shoulder, working out how can they squash competition. On the other hand, you know, I see hundreds of pitches where people say, look at the profit pool of the banks, and we're going to take this subsector and 1%, therefore my business is worth this. You know, that's the wrong way to think about it. But I think, yeah, in the last 12 months, we've seen a big difference where banks are definitely more open to conversations. I think the time is still to evolve where banks really do understand that startups have real competitive advantage in speed and the technology they bring and the people they can hire. I think we're a number of years away from fintechs evolving on a mass scale before banks will buy them. You know, we're seeing some of that stuff in mortgage broking, you know, that's come through. But I think you're going to start to see some brands emerge in some of their very strong profit pools that they'll either be buying or trying to collaborate with in a meaningful way.
I might just getting a few questions here from the audience. So I'll start with one of the first ones. How did you work through the process of bringing on additional investors, i.e. increased funding, capital comes with more stakeholders to manage?
So is that question directed at equity capital or at lending capital? Whoever asked that question. I can answer both if you like.
Equity, I think, more than that.
Equity? Yeah. Okay. So prior to our IPO in December last year, we probably had around 100 private investors. And being a fast-growing private company, there are a whole bunch of requirements for reporting to investors. Obviously, being a listed company, those requirements become more significant. But we were in a pretty good process. We were in a pretty good flow of communicating with investors. So, 4 months into being a listed company, I'd say not a whole lot has changed in terms of the level of reporting, etc. Obviously, it's now more public what we're doing, so that's definitely a change. But as far as managing investors, it's possibly even easier as a listed company because you've got one set of requirements, and you've got a quarterly cash flow and a half-year requirement and a continuous disclosure requirement. So there's a well-worn path there. Whereas with private investors, you can often have maybe 3 or 4 different groups of private investors call you in a week. You need to communicate with each of them separately. So I'd say not a huge difference, given that as a private company we had pretty significant investor reporting requirements.
Stephen did a fantastic job. He underplays that. Stephen, one of the great things he did is really sell his vision and persuade people what he was going to build, and followed up on that. And me and my fund, we were investors in every single round, all the way through to IPO. And each time you're really examining what have they delivered, what's the future look like. And Stephen's done a fantastic job of that all the way through. So, that's the entrepreneurial spirit.
That's right, Dean. You mentioned that Stephen is very persuasive. Is a very persuasive person when you pitch or speak to investors. So I've got a question here about the listing. You're obviously Australian. You have a lot of Australasian investors into Credible, but you're a US-based company. What was the decision to list on the ASX and at this point of time?
Yeah, so I get that question a lot, actually. The short answer is capital flexibility. So being a public company, obviously there's an ability to raise capital quickly if we need to, and I see that as a real competitive advantage as the market, the competitive landscape in the US changes. I think it's important to be able to raise capital to go after opportunities as they arise, and they are coming at us thick and fast at the moment. So capital flexibility is a big part of it. Obviously, I'm from Australia and I worked in capital markets here for about 10 years, so I understand how the whole system works. And our decision was not about do we list on the NASDAQ or do we list in Australia, because we're too small for NASDAQ at this point in time. It was, do we take private capital in the US or do we list in Australia? And given that 80% of our investors pre-IPO were based in Australia or Asia, made that decision a little bit easier. But really it's capital flexibility is the main reason.
And the next steps for Credible, I believe, according to some of your latest ASX announcements, you're looking to get into the mortgage space. What's next in terms of what you're planning on doing for Credible, and do you plan on coming to Australia at all?
Yeah, so the short answer on coming to Australia is no. We've got our hands full in the US. I alluded to it earlier that we've built a technology platform over 5 years, a true technology platform, an origination from click basically all the way to close. And what that's given us is sort of the core elements of the origination process in really any debt category. And so mortgage being a $1.7 trillion a year origination market is obviously very attractive. That core technology that we've built, eligibility systems, credit bureau integrations, CRMs, lender integrations, there's a lot of overlap with mortgage. Now, mortgage is super complicated, but it's something that we've set internally. Our vision is to launch a product by the end of this year, which we announced to the market at the start of this year. And that's a little ahead of plan. So we're excited, and we see a huge opportunity for applying the technology that we've built in the student loan, personal loan verticals into what is an enormous category.
Sure. I can see we're out of time. I'm sorry I couldn't get to all the questions, but I'm sure Stephen and Dean might be around for a little while more, so you can ask them then. But thank you both for your time.
Thanks.
Thanks.